it's not recording so that we don't miss out. Okay, then. Now, last time, we started with cost of capital after I listed the cost outline for the diets. Of course, under cost of capital, I gave you the introduction that cost of capital represents the compensation required by the providers of capital from their investment in a company, and it is determined by the market forces of demand and supply, depending on the perceived risk, which means that the higher the risk associated with the company, the higher the cost of capital that the company will pay. Then we move to importance of cost of capital. I said that there are two key importance of cost of capital. One is for project evaluation. Then two is determining debt equity proportion. For the project evaluation, we said that cost of capital is needed to appraise the future expected cash flow when determining the financial viability of a project. Okay, anytime you want to determine, you want to evaluate a project, you want to determine the financial viability, then you need cost of capital to discount the future cash flow to the present value equivalent. All right, using relevant investment appraisal technique, whether NPV, all right, internal rate of return, modifying internal rate of return, or adjusted present value, whatever the technique that you want to use. So there are all those discounted cash flow technique. So you are going to use the cost of capital to get your discount factor. You now multiply with the future cash flow to get the present value. All right. Then the second one is determining debt equity proportion. All right. In the capital structure of a company, cost of capital will enable a company to determine the proportion of equity and debt to be carried. All right, to be carried in the capital structure. All right, and I said that capital structure is the way and manner a company finances its operation, and that there are three major sources of long-term financing, which is one, ordinary share capital, two, preference share capital, and debt capital. Each source of finance has its own underlying cost. All right. So therefore, the company wants to minimize the overall cost of capital. All right. So you need to know what is the percentage of debt, what's the percentage of equity as a company to be carried in the capital structure, so that in order to minimize the overall cost of capital. So those are the key importance of cost of capital. Then the third area that we talked about is the categories of cost of capital. I mentioned to you on that day that basically there are three major categories of cost of capital. We talk about traditional weighted average cost of capital. Okay, traditional weighted average cost of capital. Then number two, I listed project specific. Okay, project specific cost of capital. Then number three, we talked about, I listed the weighted average cost of capital of combined activity, which I always call a WACC. All right, and then we started with traditional WACC. Okay, under the traditional WACC, and I told you when to calculate traditional WACC. I said that traditional WACC should be computed when information on capital structure as well as their underlying costs are given in a question. If you are given information on ordinary share capital, okay, preference share capital, or debt capital, all right, including their underlying costs. For example, the cost the company will pay under ordinary share capital is dividend. You are given information on dividend. For preference share, too, is fixed dividend, all right, fixed dividend. Then for debt, the cost the company will pay is interest. Therefore, when you are given information on, when you are given capital structural information, all right, you remember what I told you earlier on, capital structure is the way and manner a company finances its operation. So we have ordinary share capital, preference share capital, as well as debt capital. So these are the major sources of long-term financing. So the cost that the company will pay to the ordinary shareholders is dividend. This dividend it will come in form of a return on investment to the ordinary shareholders. All right. Again, the fixed dividend for preference share will also come in form of a return on investment for the preference shareholder. The interest is a return on investment to the debt holders. So when you are given information on the capital structure, then you need nobody to tell you that you are supposed to calculate traditional WACC. Okay. Now, and I mentioned there are 4 procedures that you are going to carry out each time you want to calculate traditional WACC. There are 4 procedures. The first procedure is to calculate. Let me look for a space. All right. Let me use steps. I'm just recapping. I did this last time. I just want to recap. Some of you have listened to the video recording. So let me just do a recap. Steps for calculating WACC. Okay. For calculating traditional WACC. The first step is to calculate cost of equity. All right. Calculate cost of equity. Then step 2, you determine cost of preference share. You calculate cost of preference share. Then step 3, you also calculate cost of debt. Then lastly, step 4, you estimate WACC. You estimate weighted average cost of capital. So these are the 4 procedures you are expected to carry out each time you want to calculate WACC. All right. So if that is the case, we now started one after the other. We started with calculating cost of equity. And of course, that's where we stopped last time. But let me explain further. Okay. I don't want to switch to the working note before so that I don't just be going back and forth. Now, I explained to you how to calculate cost of equity. But first thing first, what do you understand by cost of equity? We said that cost of equity represents the minimum required rate of return expected by the ordinary shareholders in a company. All right. And it is also known as opportunity cost of capital. Okay. Now, we now said estimating cost of equity. How do you calculate cost of equity? I told you that there are 3 major methods of calculating cost of equity. 1 is dividend valuation model, 2 is capital Z pricing model, and 3, Miller and Modigliani formula. Okay, you can use M&M to calculate cost of equity. Then we started with, I don't want my pen to go off. That's what I must write something on the screen. Now, and I said, how do you estimate cost of equity using dividend valuation model? I said cost of equity using dividend valuation model or dividend valuation model will be used to calculate cost of equity when information on dividend and share price are given. So when you are given information on dividend as well as the share price, you are expected to use dividend valuation model to compute cost of equity. Therefore, what is cost of equity using dividend valuation model? The cost of equity using dividend valuation model represents the ratio of dividend to share price. Okay, the ratio of dividend to share price. So if that is the case, I now demonstrated for you how to calculate cost of equity using dividend valuation model. I said cost of equity is calculated as the ratio of dividend to ex-div share price. So depending on whether dividend is constant or dividend will grow. Okay, and I demonstrated the two. I don't want to talk too much on this so that we can move on. I said number A, where dividend will remain constant. Where dividend is constant. Okay. If dividend is constant, that is, dividend will not change to remain the same to infinity, then in that case, cost of equity denoted as KE will be computed as the ratio of dividend to ex-div share price. So you pick the current dividend. Okay, you divide it with the ex-div share price. ex-dividend share price, everything multiplied by 100%. So this is one formula for calculating cost of equity, where dividend will remain constant to perpetuity. Now, and I mentioned again that examiner can ask you to calculate market value of equity, where dividend is constant. In this case, market value of equity represents the present value of future cash flows discounted at the rate of return on equity or cost of equity or dividend yield. Whichever one the examiner has given to you is the same thing. It could be cost of equity, it could be rate of return on equity, it could be dividend yield. It's the same thing you are talking about. All right. So when you want to calculate market value of equity, simply divide the current dividend with the cost of equity. That is, to calculate market value of equity, just cross multiply this formula of cost of capital, cross multiply it. So in this case, this will now give me, I can say, market value of equity, we said is the ratio of dividend to cost of equity, or is the present value of future cash flow discounted at the dividend yield or at the cost of equity or rate of return on equity. So I would just say current dividend divided by, this is minus Ex-div dash, okay? So divided by KE, which is cost of equity. Of course, the market value is always in naira. It is the cost of capital that is in percentage. The market value will always be in naira. Okay, don't go and be writing naira by the side. So just for explanation purpose. Then the second part, where dividend will grow. Where dividend will grow. Okay, where there's growth in dividend payments. So in this case, cost of equity will be computed as the current dividend. Current dividend is denoted as DO. Current dividend multiplied by 1 plus the growth rate. All right, I don't want to repeat this one too much. I've done it before. All right, divided by Ex-div, share price, plus the growth rate. All of these multiplied by 100/1. So this is the formula I gave to you last time for calculating cost of equity where there's growth. So if you want to calculate market value of equity where there's growth, then it will be computed as current dividend multiplied by 1 plus the growth rate, all right, divided by cost of equity minus the growth rate. So the G that you have here is what you have here. The cost of equity you have here is what you have as your denominator. The numerator remain the same, all right? So, and I told you that this particular formula is, you may likely need it when we get to business valuation, because you are going to see this one is more technical. This other side is more technical than this side. All right. Then in your exam, it's possible you may have the one that you may need the formula that involve growth calculation, the calculation of growth rate. Then after this, we also talk about Ex-div and cum-div. And I said that Ex-div share price is the share price that excludes dividend. And then in the calculation of cost of equity, only the Ex-div share price should be used, that you don't use cum-div. Cum-div share price, I said, represents the share price that include dividend. Before you can calculate cost of equity, the dividend must have been paid. So if dividend has not been paid, it means that the share price given to you is cum-div. All right. And you don't use cum-div share price to calculate cost of equity. It has to be Ex-div share price. And that's why in my third time, I always like to use Ex-div share price as the denominator. I like to use Ex-div share price as the denominator so that students don't forget. When I put Ex-div share price, your mind will be there that, okay, you need to go to the question and confirm if dividend has been paid or not. But if I just put share price, you may be too anxious, or you may be too eager to just solve and move on without taking into consideration of whether dividend has been paid or not. Okay, so that is as per that. So then finally we talk about growth rates. How you can see in this formula we have growth G. How do you estimate the growth rate? I gave you two methods of calculating growth rate. Number one is historical pattern of dividend payment. Then two, Gordon growth model. And I said the historical pattern of dividend payment is also known as averaging method. All right. It is used to calculate cost of equity where the history of dividend payment are given. All right. When you are given the history of dividend paid over the years, and in that case, you are supposed to calculate cost of equity. You are supposed to calculate growth rate using the historical pattern of dividend payment. Then, but if in the question you are given information on earnings as well as the capital employed, then in that case, you are supposed to use Gordon growth. So using the historical pattern of dividend payments, historical pattern of dividend, historical pattern of dividend payment, I said growth rate, it will be computed as n minus 1 divided by n minus 1 into square root latest dividend divided by dividend paid in the first year, all minus 1. So you use this formula when the history of dividend paid is given to you year on year. Say, for example, you have year 1, year 2, year 3. You are given the amount of dividend paid in year 1, dividend paid in year 2, dividend paid in year 3. When you are given the amount of dividend paid for all the relevant years, then this is the formula you are going to use. But if in the question you are just given the history or the amount of dividend paid in the first year and the current year, in that case you cannot use this formula. Rather, you are going to use G equal to N into square root latest dividend divided by dividend paid in the first year, all minus 1. There is difference between the two. This one, the first one has minus 1. This one does not have minus 1. You use this one when the first year dividend and the current year dividend are given. Okay, when the first year and the current year dividend are given, that's when you use this formula here. That's what I explained to you last time. Then under the Gordon growth, I said that when information on earnings as well as capital employed are given, then you are supposed to use Gordon growth model. Using Gordon growth model, growth rate is calculated as return on capital employed multiplied by retention rates. Therefore, the return on capital employed will be calculated as earnings, okay, earnings divided by capital employed, okay, divided by capital employed, or multiplied by 100 over 1. Then the retention rates, of course, I also told you this capital employed can be defined in several ways. It could be total assets, it could be net assets, it could be equity plus debt. All right, whatever it is, the information will be there to show you how you are going to compute your capital employed. At times, it could be opening shareholders fund as your capital employed. Whatever it is, the information will surely be there. Then number B, which is the retention rate. Retention rate from these earnings, from the earnings the company has achieved. Therefore, part of it will be paid out as dividend, then part will be retained in the business. The proportion that is retained in the business is the retention rate. So we then say earnings. To get the retention rates, pick your earnings minus dividend, okay, divided by earnings, or multiply by 100%. You get your retention rate. Alternatively, you can say earnings per share minus dividend per share divided by earnings per share, or multiply by 100%. Okay? If you don't want to do it this way, you can say 1 minus dividend payout ratio. You are still saying the same thing. You get the same answer. All right. So these are the concepts that we discussed in our last class. Let me see. Let me see if you. Okay. Please remind me. Did you solve any question on Arsenal? This Arsenal PSC?
No.
We did. Even Sanchez too, we did not solve it.
Yes, we didn't solve any question.
Oh, okay. So if that is the case, let's have short example. So this is not the kind of question you are going to see on the day of your exam. This one are just to explain the concept. Are we together? These are just to explain the concept. So let's take it one by one. All right. Especially for those of you that missed the first class. So now, let's start with the illustration number 1. These are just short examples though. Arsenal PLC is financed with 10 million ordinary shares of 1 naira each, currently quoted at 1 naira 25 kobo cum-div. You recall what I mentioned to you earlier as per cum-div and ex-div. So when you are given cum-div share price, cum-div share price simply means that that share price includes dividend. But when you are given ex-div share price, it means that the share price excludes dividend. All right? So, and you don't use cum-div share price to calculate your cost of equity. It has to be ex-div share price. So let's move on. The company current dividend of 22 kobo is about to be paid. All right? That's tautology. You've already told me that the share price is cum-div. Now you are telling me the dividend is about to be paid. I already know because I've seen cum-div. Once you are given cum-div, it means that dividend is outstanding. Dividend has not been paid. But here, examiner is also saying the current dividend of 22 kobo is about to be paid. And this dividend will remain constant to perpetuity. Very straightforward. All right. So two things the examiner wants to test in this particular question. One is to demonstrate, is to show you how to calculate cost of equity where dividend will remain constant to perpetuity. Then two, how to convert cum-div share price to ex-div share price. So if I want to solve this particular question, I will say, let me just manage here. I will say Arsenal PLC. Examiner is asking us to calculate cost of equity. I would then say calculating. I don't want to switch to working notes. Let me manage here first. Calculating cost of equity. Okay. So the cost of equity is denoted as KE. So I would then say KE equal to, because examiner has told me that dividend will remain constant to perpetuity. So in this case, it will be current dividend. The formula I'm going to use will be current dividend divided by ex-div share price. Ex-dividend share price multiplied by 100 over 1. So I will then go to the question, what is the current dividend? Examiner has told us that the current dividend is 22 kobo. So 22 kobo is 0.22 divided by ex-div share price. So the share price given to, you are told that the share price, the ordinary shares of 1 naira each, currently quoted at 1.25 cum-div. So when you are given quoted price is simply means market price or share price. So which is 1.25. I cannot come in and put 1.25. When I put 1.25, that means I'm saying that dividend has been paid. Whereas examiner has told you that dividend has not been paid. So I cannot put 1.25. So I need to go and convert the 1.25 cum-div share price to ex-div share price. So how do you do that? I will then say, I will go and do my working separately. Ex-div share price equal to cum-div share price minus the current dividend minus the current dividend. Okay, so the cum-div share price is 1 naira 25 kobo. Current dividend is 22 kobo. When you minus it, this will give you 1.03. Therefore, ex-div share price is 1.03. So I would then come here 1.03 multiplied by 100 over 1. Give it to me. What's the final answer? What do you have there? 0.22 divided by 1.03, then multiply by 100. What do you have? Are we together or I'm on my own? 0.22 divided by
21.35.
21.35. That's 21, approximately 21%. Thank you. This 21%. So the cost of equity is approximately 21%. So where dividend will remain constant to perpetuity, and when you are given a cum-div share price, this is how to calculate it. That's what this question wants to test. All right, so that is as per that. Now, the second illustration, the second example here. Please let me know if I'm too fast. Let me calm down, and where I will moderate, because I wouldn't know whether I'm too fast or too slow. So you have to call my attention. If I'm too fast for your liking, please call my attention. You need to understand it. That's what I'm taking my time. Ordinarily, I would have moved to the cost of preference share since I've done this last time. But I want you to understand. That's why I'm taking my time. Because when you get to strategic financial management, all this thing I'm taking you, you are still going to do it. So, but if you don't understand it now, it will be an issue then. So I don't want you to drag. So you need to understand the basics. All right. Don't cram it. Understand the basics. All right. Move on from there. Somebody is sending, let me look at the charts. Noisy, my place, no light here. Oh, Alexa, no, sorry. I will provide light for you over there. Don't worry. You'll be fine. Just listen to the video. Okay. All right, then let's move on. Yes, the second illustration. So this particular illustration wants to test cost of equity with growth in dividend payment. All right, let's look at it together. Okay, Sanchez PLC is financed with 20 million ordinary share capital of ₦1 each, currently quoted at ₦1.25. The company current dividend of 22 kobo is about to be paid. If I'm the one reading this on the day of the exam, I will just underline is about to be paid. That means that dividend is still outstanding. And that in that case, this share price of ₦1.25 is cum-div because dividend has not been paid. And this dividend will grow at a rate of 5% per annum to perpetuity. Therefore, calculate company's cost of equity capital. So we want to calculate cost of equity. So in this case, I would then say the name of this company is Sanchez. Let me write that. Sanchez PLC. What do you want to do? We have to calculate cost of equity. I would then say calculating cost of equity, which is KE. So examiner has given us growth rates. We are given growth rate of 5%. So in this case, the cost of equity will be calculated as the current dividend multiplied by 1 plus the growth rate divided by Ex-div, ex-dividend share price plus the growth rates. All of this multiplied by 100 over 1. So this is the formula for calculating cost of equity where there is growth. So the beauty about this question is that examiner has given us growth rates. Therefore, I will then go back. My DO is the current dividend. According to the question, we are given a current dividend of how much? 22 kobo. The current dividend of 20 kobo is about to be paid. Therefore, DO is 0.20 multiplied by growth rate is 5%. We are given growth rate of 5%, all right, per annum. Therefore, 1 plus 5% will give us 1.05. All right, so divided by Ex-div share price. So the share price given to us in the question, the quoted price for Sanchez PLC is 1.25. This 1.25 included dividend because you are told that the current dividend of 2020 kobo is about to be paid. It means that dividend has not been paid. So if dividend has not been paid, I cannot use the share price of ₦1.25 kobo. So I have to convert it to Ex-div share price before I can use it. Therefore, I will go and do my working. So I want to calculate Ex-div share price. So the Ex-div share price, let me use tabular methods in this time around. So I will say Ex-div share price. To get the Ex-div share price, I will pick the current, so I will pick the cum-div share price, which is 1 naira 25 kobo. Then I will less current dividend. Current dividend of 0.20. The difference will give me 1.05. So that 1.05 is the Ex-div share price. So I will then come here 1.05 plus the growth rate of 5%. So you multiply by 100%. What's the final answer, please? So always come with your calculator while you are in my class. It's very important. Don't leave everything for me. So you have to be supporting me. You have to make the class as interactive as possible by contributing your quota. So give it to me. What do you have here? What's the final answer? So when you are doing this, when you are using your calculator, you start with the dividend 0.2 multiplied by 1.05 equal divided by 1.05 equal plus 0.05 equal multiplied by 100%. So yeah, give it to me. What do you have there? Moses.
25.
25%. Okay, thank you. We are going to quarrel. We are going to quarrel. If you are not providing me numbers, I will quarrel. I will quarrel with you. Huh? I can quickly get angry. So please don't let me get angry. Hmm? If you annoy me, that thing I did 100 years ago, I can repeat it again. It's my doing. I can repeat it again. So always give me numbers. All right then. So this is how to calculate cost of equity. You can see where I need to make adjustments, I have to make it before I compute it. But you must understand what you are doing so that all these little things, they matters. By the time you see a bigger question, all right, so all these little things, you then appreciate it. All right, this is not like I said, this is not the kind of question you are going to see on the day of your exam. This is just to test the principle, to explain the principle so that I want to drive home the point. That's why we are solving this kind of a small question. This is not the real question. When we get there, you will see. All right. So that is basically that. Next, let's have another illustration. Let's solve this illustration. Let me see if I can get up space here. Okay. I will have to use my working notes in this case for the next example. Okay, let's solve this illustration number 3. Somebody should help us read. Who is helping us? Ruth. Ruth,
Yes, sir.
please go ahead. Help us read it.
Ozil PLC is a company with 5 million ordinary shares of 1 naira each, currently quoted at 1 naira 40 kobo as at 31st December 2012. The company's current dividend of 30 kobo is about to be paid. The historical trend of the company's dividend is given below. We are given year 2007 to 2012, the dividend as given. Then you are required to calculate the company's cost of equity capital.
All right, thank you very much. Please pay
Welcome.
attention. Now, you are required to calculate the company's cost of equity capital. You want to calculate cost of equity. And this is the information you have in the question. So what are you supposed to do? It's still the same procedure. You want to calculate cost of equity. First thing first, before you put down your formula, you need to confirm from the question. Is dividend constant or dividend will grow? Because in this question, you are given dividend from 2007 to 2012. The dividend paid from 2007 to 2012. All right. You can see that dividend has increased from 15 kobo to 30 kobo between 2007 and 2012. That means there is growth in dividend payment. That means dividend has grown. So, but the growth rate is not given to you. Therefore, you need to work it out. You need to calculate your growth rate based on the information given. Then two, examiner also mentioned to you that the current dividend of 30 kobo is about to be paid. That means dividend is still outstanding. If dividend is still outstanding, the share price, the quoted market price of the company share, which is 1 naira 40 kobo, is cum-div. So you need to convert it to Ex-div share price when you are calculating your cost of equity. So that is what examiner wants you to test in this particular question. So let me switch to the working notes so that, because I need a bigger space, I will stop sharing this and move to the working notes. Okay. Let me know if you can see my working notes. Can you?
Yes, sir.
Okay, then. So the name of the company is
OZ PLC.
OZ PLC. OZ, let me put it down. Illustration 3. Page, that's on page, let me check. Page 45, illustration 3. Okay. Now, the name of the company is OZ PLC. So examiner is asking you to calculate cost of equity. I would then say calculating cost of equity, denoted as KE. So in this case, we have identified from the question that dividend will grow because we are given dividend from 2012, from 2007 to 2012, and dividend has increased from 10 kobo to 30 kobo. Is it 10 kobo in 2010? Sorry, 15 kobo, yes. So in that case, dividend will grow. So I would then say cost of equity equal to the current dividend multiplied by 1 plus the growth rate. Okay, then divided by Ex-div, X excluding dividend, that's Ex-div, share price, plus the growth rate. All of this multiplied by 100 over 1. So this is the formula for calculating cost of equity where there is growth. So I will then go back to the question. The current dividend, the current year is 2012. What's the dividend in 2012?
30 kobo.
30 kobo, so 0.3 multiplied by, the growth rate is not given to us, so you have to go and calculate the growth rate. So I will then do my workings. Let's start the workings here. Working number 1, I want to calculate growth rates. G. So I need to ask myself, how am I going to calculate the growth rates? Am I using historical pattern of dividend payments, or am to use Gordon growth model? I told you when I was explaining that the historical pattern of dividend payments should be used for calculating, or should be used to calculate cost to growth rates where the history of dividend paid are given. So in this case, examiner has given you the history of dividend paid from 2007 up to 2012. So in that case, you are supposed to use averaging method or historical pattern of dividend payment. So I would then say G is equal to N minus 1. You can see in this one, the dividend paid from 2007 up to 2012, the history were given to you. All right. In that case, you are going to use the first formula that I provided. So which is N minus 1 divided by this, sorry, N minus 1 into square root latest dividend divided by dividend paid in the first year, all minus 1. So this is the formula that you are supposed to use. So I would then say G is equal to, from 2007 to 2012, how many years?
6 years.
That's 6 years. So that means N is equal to 6. N is equal to 6. I would then say 6 minus 1 into square root latest dividend. Dividend in 2012 is how much? 30.
30.
Oh,
Dividend in the first year dividend paid is 15. All minus 1. So in this case, I can convert it mathematically. 6 minus 1 is equal to 5, isn't it?
yes.
6 minus 1 is equal to 5. 30 divided by 15 is equal to 2. So I can say 2 raised to power 1 over 5. 6 minus 1 is equal to 5. So you convert this square root, convert it to power of 2. So all minus 1. So this will give me the answer. So G is equal to, bring out your calculator, 2 raised to power 0.2. 1 divided by 5 is 0.2. So 2 raised to power 0.2. 2 raised to power 0.2 equal, then minus 1 equal, multiply by 100% equal 14.87. That's approximately 15%. So the growth rate is approximately 15%. I believe it's clear. Do you understand how we are doing this? Do you understand?
Sir, that
I
2
don't
raised
want you
to
to.
power. Okay.
Go ahead. Go ahead.
Okay. The last part, the 2 raised to power 1
1
over.
over 5.
Yeah. So I heard you mention
What?
another number there to get this 15% because I was thinking 2 raised to power 5 to be maybe 10, then minus 1
It's
to be
not 2 raised to
9.
power 5. 2 raised to power 0.2. 1 divided by 5 is 0.2.
Okay, sir. All right.
2 raised to power 0.2. So 1 over 5 is 0.2. So instead of us to be doing it like primary school, to say that's a waste of time to be saying 2 raised to power 0.2 minus 1. It's a waste of time. So when it's 1 over 5 is 0.2, right? So 2 raised to power 0.2, whatever you have, that's 14.8 something. Then you less 1, you multiply everything by 100%. So it will give you 15%. Okay.
All right.
Grace,
Thank
is
you,
it
sir.
clear?
Yes, sir. Very clear.
All right then. So let's move on. Now, we have calculated the growth rate to be approximately 15%. So let's go back to our calculation. Here is 1 plus 15% will give us 1.15. Okay, then divided by Ex-div share price. According to the question, we are told that the current dividend of 30 kobo is about to be paid, which means that the share price of 1 naira 40 kobo is cum-div, and we cannot use cum-div to calculate cost of equity. So let's go and calculate Ex-div share price. Working number 2, Ex-div, ex-dividend share price. Okay. So to get the ex-div share price, you less current dividend from the cum-div share price. So you take cum-div, cumulative dividend share price, which is 1 naira 40 kobo. You less the current dividend of 30 kobo, 0.30. The difference is the Ex-div share price, which is 1.10. That's the Ex-div. So this is how to convert cum-div share price to Ex-div share price. So I can then proceed. I will then come here 1.10 plus the growth rate. Growth rate is 15%. All of this multiplied by 100 over 1. A wise student should have gone ahead. Just give me the number before I ask you. What's the final answer? 0.3 multiplied by 1.15 equal, divided by 1.1 equal, plus 0.15 equal, multiplied by 100%. Give it to me, please. Yes.
46%.
Thank you very much. You are correct. It's approximately 46%. The cost of equity is approximately 46%. Please let me know. Is there anything that is doing you why in what we just did? If there's anything that is doing, let me explain to you. All right.
Excuse me, sir.
Yes, talk to me. That's Kemi, right?
Sorry, sir. Yes, last video that I was, because I wasn't in the class, the cost of equity formula given to us is DO into 1 plus growth rate divided by Ex-div share price. But I'm seeing that after in this your calculation, sir, we are still adding G before the 100% over 1.
Take your question
In the
again.
formula given in the class, I mean in the last, in the first reported video, we
Yes.
DO into 1 plus
Let me put it
divided
down
by
for you. Yeah,
Ex-div.
you said, hold on, Kemi. You said I gave you the cost of equity equals to DO,
into 1 plus growth into 1 divided by Ex-div share price,
Okay.
all multiplied by 100 all over
What
1.
again?
That's
All
all
multiplied
I
by,
have here in my book.
no, that is
By
G.
100
Then
over 1.
you have to add with, you have to plug, you have to add a growth rates. You have to add growth
Okay.
rates.
You mean
There must be plus
when,
G.
is it only when there is growth, or when there's no growth, the plus G will
Yeah.
be there?
Where, as I have already explained, where there is growth rate, this is the formula you are supposed to use. This is the formula where there is growth. This is the formula for calculating cost of equity. Where there is no growth, it's just cost of equity will just be DO divided by Ex-div share price multiplied by 100%. That's all. Where there is no growth, this is the formula where there is no growth. Where there is growth, this is the formula you're expected to use. All right, Kemi?
Yes, sir.
Yeah.
Thank you.
You're welcome. Okay, so that's that. Let's move on to the next one. Let me see. Let me stop sharing this and go back to that, to the material. Let me see if there's anyone I want to add before we go to cost of preference share. Okay, I think that's it. So when we get to weighted average cost of capital, we solve a bigger, we are going to solve bigger questions. So these are the concepts of cost of equity that I've explained to you. We did it last time, and I'm also doing the same now. Now I've practicalized it using some examples to demonstrate or to drive home the point. Yes, that is as per that. Let's go back to the material and discuss cost of preference share. Let's talk about cost of preference share. I may likely, okay. So in order for me to be able to express myself very well, let me just maintain the working note to do the cost of preference share. So you can open to the material at your end so so that to follow through. All right. So let me just, okay. Let me,
Yes, sir.
pardon?
Excuse me, sir. Are we now looking at the other methods of calculating cost of equity?
Which is
We
a
still have
capital asset
capital
pricing model. So no worry.
and and
Yeah, capital asset pricing model is a topic on its own. All right.
oh,
You know, last
yes,
week I
sir.
listed the topic with you. I mean, I listed the topics that I'm going to take you for the FM scope. So when we get there, capital asset pricing model is a topic on its own. When we get there, you will see all those ones. Then also, we are going to do, of course, adjusted present value is not part of your syllabus. But when we get there, we'll explain to you when to use Miller and Modigliani. All right. Okay. What is important now is this dividend valuation model. In fact, that's likely the area you are going to be tested. So let's move on. Now, cost of preference share. Cost of preference share. So let me explain. Here is KP. Good evening, sir. Please come of us. Some of us don't have the material. If you are not in the if you are not in the PFM group, you may not have the material. The material is shared with those that have made their payments in the FM group. So if you are not in the FM group, you will be able to have access to the material until when you do when you perform. Let me put it that way. When you perform, then you'll be in the FM group. From there, you have access to the material. But however, somebody can help me. Well, this may not even work. I would have said somebody should scan it, should scan the questions and then share. But I will see what I can do at the end of this class. I will see if I can scan all those questions, send it to you so that you have access. Pending it. Earlier today, I mentioned to you that there are 4 procedures of calculating traditional WACC. One is to calculate cost of equity. 2, calculate cost of preference share. 3, calculate cost of debt. 4, calculate WACC. Now, I've shown you, I've demonstrated how to calculate cost of equity. The next thing we want to discuss is how to calculate cost of preference share. But first thing first, you need to understand what is preference share, what is cost of preference share, what are the types of preference share, how do you compute cost of preference share. So that's what we want to discuss under this. All right. So the cost of preference share is the rate of return expected by the preference shareholders from their investment in a company. I repeat, cost of preference share is the rate of return expected by the preference shareholders from their investments in a company. Okay. The cost of preference share is computed as the ratio of dividend to Ex-div share price. Of course, the ratio of fixed dividend to Ex-div share price. Now, the preference shareholders is ranked over the ordinary share. I'm sorry, the preference share is ranked over the preference share. And in the event of liquidation of a company, when a company liquidates, the preference shareholders will be settled before the ordinary shareholders. Of course, after the debt holders must have been settled, all right, because there are order of settlements in the event of liquidation of a company. So, but what we are saying in essence is that cost of preference share represents the ratio of fixed dividend to ex-div share price. One thing you also need to understand is that as far as cost of preference share is concerned, there's nothing like growth. The dividend is fixed. There is no growth as far as preference share is concerned. Okay, now preference share could be cumulative, non-cumulative, participating, non-participating, redeemable, or irredeemable. All right. So all those cumulative, non-cumulative, participating, non-participating, they are purely theoretical. The one where you are going to have calculation is redeemable and then irredeemable preference share. Let me just mention it. When you talk about cumulative preference share, the cumulative preference share is the one in which the preference dividend could be cumulative of other years. Say, for example, as a cumulative preference share, if a company makes, of course, preference dividend will be paid. Preference dividend will be paid from the profit earned by a company at a particular period. So in a year or in a period whereby the company make losses, all right, if a company make loss, you cannot pay dividend because that dividend is supposed to be paid from profits. So in a year the company make loss, there's no way you'll be able to make you'll be able to pay dividend. Therefore, that dividend you are supposed to pay in the first year, for example, you carry it forward to the following year. If in the following year the company also make loss, then you continue to cumulate it. So you are going to add the dividend you are supposed to pay in the first year, you add it to the one of second year which you have not paid. Then if in the third year the company now make profits, then you need to first of all, you are going to pay all the outstanding dividend you are supposed to that you have been accumulating. You need to pay it from the profits that you have earned. So if the profit is not sufficient to cover the outstanding dividend, then you just remove whatever you deduct, whatever that can be covered. The balance, you push it forward. That means we are accumulating it. So it's cumulative of other years. If it is non-cumulative, which means that if a company make loss in a particular year, that dividend will be forgone. So there's no way you can recover it because there is no loss to pay. Sorry, there is no profit to pay the dividend. So in any year a company make loss, or in any year there is zero profit, there is no profit at all, then in that case you cannot pay dividend, you cannot pay the preference dividend, you ignore, you move to the subsequently. All right, so you cannot cumulate it. So that's different between the two. Cumulative preference share, you can be cumulating the preference dividend until profit is available to cover the outstanding dividend. But for non-cumulative preference share, the dividend cannot be accumulated. So you cannot accumulate preference dividends. So in any year there is no profit, just forfeit. You forfeit the preference dividend. The investor will forfeit the preference dividend that's supposed to earn. So that is that. Now, the major one where we have work to do is under the redeemable as well as the irredeemable preference share. So let's talk about irredeemable first. Irredeemable preference share. Okay, irredeemable preference share. Now, when you talk about irredeemable preference share, is the one in which, let me see if I can, let me just put it down. This is the type of preference share. This is the type of preference share in which the company will pay the fixed dividend, we pay the fixed dividend, but the principal will not be repaid. That's why it is called irredeemable. The principal will not be repaid. So as far as irredeemable preference share is concerned, every year when the company makes profits, so you pay preference dividend. But at the maturity date, the company is not expected to repay the principal sum. Okay, at the maturity date, the principal will not be repaid at the maturity date. Okay, so that is as per that. All right, so to infinity, the company continue to pay fixed dividend, but the principal will never be repaid. The principal will never be repaid. Now, that is irredeemable preference share. So how do you then calculate the cost of irredeemable preference share? Cost of irredeemable preference share, which is denoted as KP. The cost of irredeemable preference share is the ratio of fixed dividend to ex-div share price. Let me just put it down for you. This is the ratio of fixed dividend to ex-div share price.
Excuse me,
Okay.
sir. Some
Yes.
of us
We are not
cannot see their
saying
working notes.
working note.
Sir, we
Seriously?
can't see your working note. Yes, sir.
Ah, I thought I was sharing the working notes. So you are just following the
What
you are seeing the
what you shared what you shared is
class material.
the material itself. Yes, sir.
Sorry about that. I thought I was sharing the no wonder. Thank you. So that means all what I've been writing since. You are not seeing it. But in any case, I've not gone far though. All
But we
right.
can see it now.
All right. Thank you. So I said cost of irredeemable preference share is the ratio of fixed dividend to ex-div share price. So let's put down the formula. So I will then say KP, that is cost of preference share, equal to fixed dividend divided by ex-div share price multiplied by 100 over 1. So this is the formula for calculating cost of irredeemable preference share. Okay, so all those concepts of cum-div, ex-div share price still apply under preference share. So where you are given cum-div share price, you need to convert it to ex-div share price. It's the same thing here. However, remember, I said that when you are calculating cost of irredeemable preference share, there is nothing like growth because the dividend is fixed. There's no growth in dividend payments. So this is the formula for calculating cost of irredeemable preference shares. So let's look for an example to demonstrate this. Let's look for an example. Let me stop sharing this and quickly go back to the question. Okay. I believe you are seeing the class notes, right? Are you with me?
Yes.
All right then. So like I said, you can just go there, you read more. I've already said of most of all these things. All right. So let me see if you can see short example to demonstrate that. Yes, let's look at this illustration number 4. All right. Somebody should help us read. I want you to contribute. Who is helping us? Let me call somebody. Some of you have been quiet since. Christiana, is that okay? Christiana Ijake, read. Christiana, are you there?
Yes, I'm here.
Thank you. Please read. Illustration number 4. Adenine PLC.
Okay. Idenine PLC as in issue preference share with the nominal value of 25 kobo. The agreed dividend of 5 kobo has just been paid. Required. What is the cost of preference share?
Thank you very much. So we want to calculate cost of preference share. You can see in the requirement, examiner did not tell you calculate cost of irredeemable or redeemable. All right. So of course, it is implied in the question. The information given to you will tell you the kind of preference share that you want to calculate. All right. So like I mentioned, it will be irredeemable. Preference share will be irredeemable. All right. Where a company will pay the fixed dividend to perpetuity, but the principal will never be repaid. That is irredeemable preference share. And the cost of irredeemable preference share is the ratio of fixed dividend to Ex-div share price. So in this case, what am I supposed to do? I will say, of course, the name of the company is Adenine. Adenine PLC. Examiner is asking us to calculate cost of preference share, KP. That's what we want to calculate. I would then say KP. Before I put it down, I need to ask myself, what kind of preference share is this one? Is it redeemable or irredeemable? Of course, it will be redeemable if and only if you are given the redemption date. In this particular question, we are not given any redemption date. We don't have maturity date. So in that case, it will be irredeemable. So I would then say fixed dividend divided by, what's wrong with you? You're not connecting. So fixed dividend divided by Ex-div share price multiplied by 100%. So that is the formula for calculating cost of irredeemable preference shares. So I would then say KP equal. I will go back to the question. Adenine PLC. What's the fixed dividend? You are told that Adenine PLC has in issue preference share with the nominal value of 25 kobo. All right. The agreed dividend of 5 kobo has just been paid. So there is no market price. So it is nominal value. Nominal value is the face value, the balance sheet value. The amount you have in the balance sheet is the same thing as nominal value or book value or face value, whatever you want to call it, is the same thing. All right. So in that case, I would then come here. My KP in this case, will be equal to fixed dividend. Dividend is 5 kobo. We are told that the agreed dividend of 5 kobo has just been paid. That means that 5 kobo, I mean is Ex-div. It's already Ex-div. The 25 kobo is already Ex-div. So I would then say 5 kobo. If I like, I can say 0.05 or I just leave it at 5. It's the same thing you get. Divided by Ex-div share price. Again, it's not a share price. Examiner has told us that it's a nominal value, but it's a formula. So just put 25. I will say 25. 5 divided by 25 multiplied by 100. So what do you have here? What do you have? 5 over 25.
20.
20%. All right. This is 20%. So the cost of irredeemable preference share for Adenine PLC is 20%. Like I said, alternatively, you can also say 5 kobo is the same thing as 0.5 divided by 25 kobo is 0.25 multiplied by 100 over 1. You're still going to get the same thing. So whichever one that is more convenient for you, do it. All right. So that is as per that. Is there any other question that relates to irredeemable preference share? So, don't forget what I said. You can't see this kind of a question on the day of your exam. This is just for explanation purpose to explain the concepts. This is not the kind of question you are going to see. When you get there, you'll be seeing all those ones. But for now, we need to explain the concepts. Now, let's talk about let's talk about redeemable preference share. Okay? Redeemable preference share. Let me switch so that we continue from where I stopped the other time. Okay? Let's talk about cost of redeemable preference share. Cost of redeemable preference share. Okay. The redeemable preference share is the one in which the company will pay both the annual fixed dividend as well as the principal at the maturity date. Let me put it down. The redeemable preference share is the one where the company, let me write it, where the company will pay the fixed dividends and the principal at the maturity dates. Let's say, for example, the preference share has 5 years maturity. So every year the company will be paying fixed dividend. Year 1, the company will pay dividend. Year 2, pay dividend up to the final year, which is year 5. Then in that final year, the company will pay the fixed dividend plus the principal sum. All right. So that is redeemable preference share. Now, what do you mean by cost of redeemable preference share? What do you mean by cost of redeemable preference share? Okay. Now, how do you compute the cost of redeemable preference share? The cost of redeemable preference share will be computed as internal rate of return. Let me put it down. The cost of redeemable preference share is computed as internal rate of return. Okay? The cost of redeemable preference share is computed as internal rate of return. Therefore, preference share will be redeemable, will be redeemable if the redemption dates or maturity dates, if the redemption or maturity dates is given. Otherwise, it will be cost of irredeemable preference share. So if in the question you are given the redemption, you are given the dates that the preference share will be redeemed, that means that preference share is redeemable. But if you are not given the redemption date, then you are going to calculate it as cost of irredeemable preference share. All right. So how do you then calculate cost of redeemable preference share? Steps. Let me show you the steps involved in calculating cost of redeemable preference share. So when you want to calculate cost of, like I mentioned, whenever you want to calculate cost of redeemable preference share, you are simply supposed to calculate internal rate of return. And you know that when you want to calculate internal rate of return, there are three procedures. One is to assume two discount rate that will produce two opposing NPV. Put it down. Step one, calculate or assume first. Assume two discount rates that will produce two opposing NPV. That is a positive NPV and negative NPV. That's two opposing NPV. All right. Then step two, you calculate internal rate of return. Calculate internal rate of return using the formula below. The internal rate of return is the same thing as cost of redeemable preference share. Let me write this. Calculate internal rate of return or cost of redeemable preference share. Okay. Using the formula below. You're already familiar with this formula. So KP or internal rate of return is calculated as lower discount rates plus NPV of lower discount rates divided by, let me write that, divided by NPV of lower discount rate plus NPV of higher discount rates, all multiplied by higher discount rates minus lower discount rates. So you are familiar with this formula already because you did it for, well, not all of you though. Okay, so this is the formula for calculating cost of redeemable preference share. It's as simple as that. All right. So once you have this, like I said, internal rate of return. Whenever you are asked to calculate cost of redeemable preference share, simply go ahead and calculate internal rate of return. That's just it. Okay. Let me see. We can have a short example to demonstrate this. Let me go back to the working notes. Sorry, to the main notes. All right. Yeah. Let's have this illustration number 5. Illustration number 5. I need one of you to read. David, read for us.
Johnson
David.
PLC
Okay.
is financed with 1 million redeemable preference shares with a nominal value of 1 naira and nominal rate of 8%, but currently quoted at naira 5 kobo ex-div. The preference share will be redeemed at par in 5 years' time. Calculate the cost of preference share.
Okay, thank you, David. Somebody is asking that I should define the variables. Okay, somebody is already defining it for you. A is the lower discount rate, B is the higher discount rate. Sorry about that. Naomi, hope you are getting it. A is the lower discount rate, B is the higher discount rate. So, thank you once again, David. So, you are told that you are asked to calculate cost of preference share. Examiner did not ask you to calculate cost of redeemable preference share because it is implied in the question. And I mentioned to you that preference share will be redeemable if the redemption date or maturity date is given. That is when the preference share will be redeemed in the future. If you are told when the preference share will be redeemed, then in that case, it should be redeemable preference share. But if you are not given the redemption date, you are going to compute as cost of irredeemable preference share. So let's solve this. Examiner wants you to calculate cost of preference share. Now, according to the question, examiner told you that Johnson PLC is financed with 1 million redeemable preference share with a nominal value of 1 naira and nominal rate of 8%. All right. That nominal rate of 8%, that is the interest, that is the dividend rate. That is the rate of dividend that the company will pay to the preference shareholders. All right. So to do that, of course, all you need to do is to multiply the 8% on the nominal value. The nominal value of the preference share will then be 1 naira. Okay, nominal value is 1 naira. So 8% of 1 naira will give you 8 kobo. All right. So the dividend that the company will earn will be 8 kobo. The market price of this preference share is 1 naira 5 kobo ex-div. That means that the preference dividend has been paid. That's why it is ex-div. Then you are now told further that the preference share will be redeemed at par in 5 years' time. So the maturity date is in 5 years' time. So since we have given the maturity date, it means that it's a redeemable preference share. So if it's a redeemable preference share, simply go ahead and calculate internal rate of return. That's just it. So let me stop sharing this because I need space to demonstrate this. Let me stop sharing this and move to the working notes. Okay. Illustration number 5. Excuse me. Page, I think it's still the same page 45. Let me confirm. Yes, page 45. Okay. I want to calculate cost of redeemable preference share. The name of the company is Johnson PLC. All right. So calculating cost of redeemable preference share. Okay. How do you do this? Let me just put it down. This will be calculated. Let me put it down for you. This will be calculated as internal rate of return. Okay, this will be calculated as internal rate of return by assuming two discount rate that will produce opposing NPV, then calculate internal rate of return. Okay, so let's move on. When you want to calculate internal rate of return, like I said, you are expected to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV, another discount rate will give you a negative NPV. Then you interpolate, you get your answer. Now, without wasting time, I will say assume. Now, under cost of capital, when you want to assume discount rate, always start from 10%. Don't start with 5. So if 10% produce a positive NPV, all right, you can increase to 15% to get a negative NPV. But if 10% produces a negative NPV, you can reduce to 5% to get a negative NPV, to get a positive NPV. This is to help you to minimize the iteration that you are going to do, because it's trial and error. Internal rate of return involves trial and error, interpolation. So to minimize your iteration, start from 10%, like I said. So assume 10%. Let's start from there. Because we want to calculate internal rate, I will show you the exam method you are supposed to use. We are going to use only one table. This will save your time instead of creating 2 different tables, wasting time on the day of your exam. So you are going to use only one table, and I will demonstrate how you are going to do it for you. So we want to calculate NPV. We want to assume 2 discount rates that will produce 2 opposing NPV. So let's calculate. We have assumed 10% first. So if this 10% is positive, we increase to 15%. But if 10% is negative, we reduce to 5%. So we then use this rate to calculate NPV. So let's calculate our NPV now. Calculating net present value. To do this, you create a column for year, description of items, cash flow, then discount factor at, we have assumed 10%, then you are going to have present value here. Okay. So let's outline, let's rule our table. Okay, so year 0. We are told that this preference share will be redeemed in 5 years' time, which means that the company will pay annual fixed dividend from year 1 to year 5. The company will pay annual fixed dividend from year 1 to 5. So because the dividend is fixed, therefore I will calculate from year 1 to 5. So at the final year, which is year 5, the company will redeem, the investor will redeem the preference share will be redeemed. So here will be the current market value of the preference share. Then here will be the fixed dividend. Then the redemption value. Okay, the redemption value. I will then go back to the question. Let me read this table first. I'm showing you exam method. Okay. NPV. Let me draw this. Now, we are assuming 10%. So I will say at 10%. So let's get, first thing first, let's put down our cash flow. The current value is the market price of the preference share. So let's go back to the question. Victor, almost something, you are drawing something on my screen. Be careful. What did you press? You are messing up my screen. Now, the current market, what's the value of the preference share? We are told that the preference share is currently quoted at 1 naira 5 kobo ex-div. So that 1 naira 5 kobo is already, dividend has been paid. So I will come here, I will calculate my internal rate of return there. Then let me start working here. Working number 1. I want to calculate the current value of the preference share, CV. So CV will be calculated as number of shares multiplied by nominal value. Sorry, we are given market value multiplied by Ex-div share price. The number of shares, the number of preference share. According to the question, Johnson is financed with 1 million share redeemable preference shares with a nominal value of 1 naira. So I don't need nominal value. I need market value. Therefore, 1 million shares multiplied by Ex-div share price, which is 1 naira 5 kobo. So this will give me 1,050,000. So the current market value of the preference share is 1,050,000. So let's come and put it there. Here will be 1,050,000. So put it in brackets. Then, like I said, this is a redeemable preference share. The company will pay annual fixed dividend from year 1 to year 5. How much is the dividend? Examiner has given you the nominal rate to be 8%. All right. So nominal rate of 8%. Now, let's calculate the dividend. Working number 2. We want to determine fixed dividend payable. How do you get the fixed dividend? This is computed as the nominal rates. Examiner has given you nominal rates. So nominal rates multiplied by nominal value. Don't forget what I said. The dividend that the company will pay to the preference shareholder will be based on the nominal value. Therefore, nominal rate multiplied by nominal rate and nominal value. So in this case, nominal rate is 8%. That 8% is the percentage of dividend that will be paid. The nominal value will then be equal to 1 million shares multiplied by 1 naira. So here will be 8% multiplied by 1 million naira, which is 80,000 naira. So the annual fixed dividend that the company will pay to the preference shareholders is 80,000. That 80,000 naira is fixed, and that's why we are calculating from year 1 to year 5. Then at the final year, this preference share will be redeemed at par. According to the question, you are told that it will be redeemed at par in 5 years' time. So at year 5, the nominal value is 1 million naira. That's the 1 million naira you have there. That's the par value. So I will then come here 1 million. Please, like I said, if I'm too fast, let me know so that I can lower the tempo. You need to understand. So that's as per that. Now, we want to determine the present value. So to get the present value, you are supposed to multiply discount factor with the cash flow. So for year 0, discount factor at year 0 is usually 1. 1 multiplied by 1,050,000 will give us 1,050,000. Here will be 1,050,000. Let me increase the space. Why are you not connecting? Okay. Let me adjust this one to the other side. Okay. Of course, this should be in brackets at 10%. Okay. Now, let's calculate annuity factor from year 1 to year 5. Annuity factor. Let's go and do working for annuity. I will expect you to give me the annuity factor. It's something you have done previously. If you have done performance management before, but in any case, assume zero knowledge. Annuity factor. When do you use annuity factor, or when do you calculate annuity factor? When you have constant cash inflow, you calculate annuity factor. Instead of doing it year by year, just use annuity factor, you get your answer, and you are good. So annuity factor will be calculated as 1 minus 1 plus r raised to power minus n, or divided by r. So this is annuity factor. So in this case, our annuity factor will be equal to 1 minus, open a bracket. We are assuming 10%. See, we assume 10% here. That's the 10% we assume. So R is 10%, N is 5 years. So I would then say 1.1 raised to power minus 5 divided by 0.10. Final answer, what do you have? 1.1 raised to power minus 5 equal minus 1 equal divided by 0.1 equal. What do you have? Give it to me. I want to see who will get it right. Yes. Don't forget what I said. 1.1. You start from the parentheses. 1.1 raised to power minus 5 equal. Okay? Just press minus 1 equal divided by 0.1 equal. What do you get over there? Or you did not try it? Anyways, I get 3.791. That's the answer. 3.791. So the annuity factor from year 1 to 5 at 10% is 3.791. So I will then come and put it here will be 3.791. So discount factor at year 5. Discount factor for year 5 at 10% will give us 0.621. Okay, so let's multiply to get the present value. You are not cooperating with me. You are leaving it to me. You are supposed to be giving all these numbers. Okay, so here will be 80,000, 80,000, 80, multiplied by 3.791 equal 303.
280.
Thank you. What's wrong with the pen? Sure. 303. Okay. 303. Anyway, let me just write it anyhow. They are not allowing me. What's in that cell? 304. 303. 280, right?
Yes.
Okay then. So the last one, of course, we want to redeem the preference share. Therefore, 1 million multiplied by 0.621 will give us 621,000. So 621,000 plus 303,280. 621,000.
924,280.
924,280 minus 1,050,000.
125,720.
125,720 negative.
Negative.
125,720 negative. So we assume 10%. We got a negative NPV. So we need to assume a lower discount rate that will produce a positive NPV. Therefore, let's assume 5%. I will then say and 5%. So here it will be 5. Where will be at 5. So, of course, this still remain 1. Multiply by 1,050,000 will give us 1,050,000 negative. So we need to go and calculate annuity factor of year 1 to 5 at 5%. Okay. This is at 5%. Let's do the one at 10%. Sorry, at 5%. Annuity factor at 5%. So this will be equal to 1 minus 1.05 raised to power minus 5, all divided by 0.05. Give it to me. What do you have there? Please, could you scroll down to the annuity factor calculation, sir? Okay, I hear you. How did you arrive at 0.621? Okay, let me show you. Let me show you how. Who asked that question? Let me check your name. What is that? Naomi. So you're asking how did I arrive at 0.621? Okay, let me show you. See, discount factor. But first of all, before I go there, what answer do you have, Ruth? Have you left me to myself?
I don't have a scientific calculator here, so I'm
Who is
using
giving me
the.
number before?
I'm the one, but
4.330.
4 points.
330.
330. Okay, let me confirm. Let me confirm.
4.329.
329. Okay, let me confirm. So I will say 1.05. Okay, raised to power 5 minus equal. I have 0.784. When I get to year 4 or year 5, I will use 0.784. Then minus 1 equal divided by 0.05 equal 4.329. 4. The first person that gave me this 4.330, the 4 you have after 9 is not equal to, okay, maybe you are doing 2 decimal place. Maybe that's why you're saying 4.33. You may be right, but we are using 3 decimal place. So this one's supposed to be 4.329. All right. So that is that. Now, Naomi, you are asking me, how did I get 0.621? That's discount factor. Discount factor is calculated as 1 plus r raised to power minus n. Or you can say discount factor is equal to 1 divided by 1 plus r raised to power n. So you get the same thing. All right, whether you use this one or you use this one, you're supposed to get the same answer. So in this case, I would then say R is 10%. So 10% plus 1, that will give me 1.10 raised to power minus 5. N is equal to 5. So when you use your calculator, this is supposed to give you, whether you are going to see this in the video, let me just try it. 1.1 raised to power minus 5. That will give you 0.62092. So that's 0.621. 0.621. Naomi, this is how we got the 0.621. Do you understand now?
Yes, sir. Thanks so much.
All right then. Okay. So I will then go back up there. 4.329. Here is 4.329. The discount factor at year 5, discount factor of year 5 at 5% will give us 0.78. Is it 784, 794? Let me do it again. Let me add it so that you understand how we got it. Discount factor equal to 1.05 raised to power minus 5. So this will give us 1.05, 1.05 raised to power 5 minus equal, that's 0.784, 0.784. That's it. Okay, then let's move on. Yeah. So the next thing we need to do is to multiply. So when you are using one table to calculate your NPVs, you have to be very careful so that you don't give what belongs to Peter to Paul. At times you may want to pick discount factor. Say for example from this one, you may want to pick from this one, but your eye can go to this side. So you have to be very careful. So let's calculate the present value. 80,000 multiplied by 4.329. What do you get?
346,
320.
346.
320.
320. Then 1 million multiplied by 0.784 will give us 784,000. So 784,000 plus 346, 320. What do you have?
1 million.
Minus 1,050,000.
Yeah. Okay, 80,320.
80,320 positive. So now we have computed both positive and negative NPV. We can then proceed to calculating the internal rate of return. We have assumed two discount rates. In this case, we assume 5 and 10%. And this 10% produce two opposing NPV, a positive and then negative NPV. So the next step we need to do is to calculate the cost of redeemable preference share. I would then say KD, or you call it internal rate of return, is equal to a lower discount rate plus the NPV of the lower discount rate divided by NPV of the lower plus NPV of the higher, all multiplied by higher minus the lower discount rate. So A is the lower discount rate. We assume 5 and 10%. 5% is lower. Therefore, 5 plus NPV of that 5. Look at NPV of the 5% is 80,320. 80,320 divided by 80,320 plus NPV of the higher, which is 125,720. All right. All multiplied by higher discount rate of 10 minus lower discount rate of 5. Mathematically, what do you have? 80, you start from the denominator. 80,320 plus 125,720 equal 80,320 divided by answer equal multiply by difference between 10 and 5, which is 5, then plus 5. What do you have? I want to see who has a magic hand or magic finger. Yes?
6.95.
6.95%. So approximately the cost of redeemable preference share is 7%. The cost of redeemable preference share is approximately 7%. Please, if you don't know how we got these numbers, or the thing is doing you why, doing you, please talk. You have to speak up. You know, I can't see your face. I can't see your face expression. Please, it's important you speak up. You are on your own. Nobody is. You are. As far as this class is concerned, you are on your own. You have to ask your question, no matter how stupid it is. So please ask your question so that you get clarity while you are in the class. It's very important. Don't be shy, please. Yes. Are we on the same page? Do you understand what I've done so far? Do you understand how we calculated this cost of redeemable preference share?
Sir,
Yes, talk to me, please.
when you were doing NPV of the negative plus NPV of the positive,
Yes.
80,000, I'm talking about the denominator, 80,320. So
Mm-hmm.
this negative now is already negative plus, that's plus and bracket minus. I was thinking that place is supposed to be minus.
No, you don't need to bother yourself on that. That one is a waste of time. I understand this is what you are saying. Originally, the formula for internal rate of return is equal to A plus NPV of A over NPV of A minus NPV of B. All of this multiplied by B minus A. Originally, this is the formula for calculating internal rate of return. And you know that the NPV of B, NPV of higher discount rate will always be negative. That's why you see from our calculation here, the NPV higher discount rate is 10%. And you see that the NPV of this 10% is 125,720 negative. So negative times negative will give you positive. Do you understand? Tolu, are you the one that has the question?
No, sir.
Okay, who has the question?
I'm the
Zoom
one.
user. Who is the person? Who's Zoom user? What's the name?
Rose.
Rose.
Yes, sir.
Rosemary, right?
Yes, sir.
Okay. So now, negative times negative will always give you positive. That's why I don't usually put negative here. If I want to do this now, this is what you say. You just say A is the lower discount rate, which is what? Which is 5%. Divided by 80,320 minus 125,720. Is it 720? Let me confirm. Yes, 720. Then all of this multiply by 10 minus 5. So you can see minus times minus will turn to positive. I will just say 5 plus 8320. When you are doing this, just a waste of time. All right. So 80,320 divided by 80,320 minus times minus will give us positive 125,720. 10 minus 5 will give us 5. This is what I've done previously. All right, this is what I've done previously. So ordinarily times minus will turn to positive. That's why I don't put negative there. Do you understand now, Rose?
Yes, I do.
Yeah. So that's it.
Thank you.
You are welcome. Any other question? because this time is fast spent. So today we are going to stop at cost of preference share. In our next class, by the grace of God, we will do cost of redeemable, and we are going to do generally cost of debt. Yes, talk to me.
I have questions from the first
From where?
video. From the first video, I was
Okay.
not able to log on time. That was why I couldn't ask in the first place. Please, I just want you to help me on the following question. What are the components of capital employed? And you said I'm talking about Gordon's growth method. And where we are not giving capital employed, you said we can use opening shareholders fund.
Opening shareholders fund.
Yes. So I just want to know what are the components of capital employed and how capital employed equals opening shareholders fund. At least the reason why we are using opening shareholders fund where we are not giving capital employed. That's my first question, sir.
I've said it that when you are calculating primary ratio, right? When you are calculating primary ratio, it's one of the limitations of primary ratio because capital employed can mean anything. I said that it could be total assets, all right? It could be net assets. It could be debt plus equity. Whatever it is, examiner will surely give it to you. You are going to have it in the question. So you can calculate your capital employed in any ways. Now, for the opening shareholders fund, of course, when you talk about shareholders fund, it's your when you go to the company's capital structure, the amount attributable to the owners, you will see all those items that relates to the owners of the business, like retained earnings, like premium, okay, like share premium and all of that. You had them together. To now get the opening shareholders fund, you are going to less dividend from the total of all those ones. So that will give you the opening share, because in the retained earnings, it is possible that you might have adjusted for dividend. All right. So in any case, as we proceed, we are going to demonstrate all of that for you, be able to see it clearly. All right. But one thing is very clear, that for you to determine your capital employed, you may be lucky, especially at this level, you may be lucky. You are going to be given capital employed directly. But if you are not given, it could be capital employed, it could be total assets. I think I wrote it down on that day too. It could be total assets. All right. It could be net assets. You can also say capital employed is debt plus equity. Okay. Whatever it is, certainly examiner, we are going to have the information in the question that will enable you to know which one to use. All right. So
Sir,
that is
the capital employed we are talking about, is it the closing capital employed or the opening one?
there's nothing like opening capital employed. All right. There's
Okay,
nothing
sir.
like opening capital employed. See, when you talk about capital employed, the amount you contributed in the business, the capital you have contributed in the business. When for your you can also call it investments. All right. Instead of capital employed, your invest. We're talking about return on investment, right? That investment is the amount is the amount you put into the business. That's your capital employed. Are we together, Kemi?
Yes,
So
yes,
if you
sir.
don't call it capital employment, it could be investments. So when you say capital employed, the amount you have used, the amount you have spent in the business, to the capital you have contributed into the business. So that's what I was saying, that it could be defined in different ways.
Mm.
Yeah. So
Okay,
that
sir.
is
Number two, sorry, is share price the same thing as the market price and the quoted
yes.
price?
Yes, you can call it market price per share. You can call it quoted price. You can call it share price. All right?
Okay. Okay.
Mm.
The par value and the nominal value, are they the same thing as the book value?
I mentioned it today. Nominal value, par value, face value, book value is the same thing. All
Thank you,
right?
sir.
You're welcome.
Thank you, sir.
Yes, any other question?
Just need you to share your notes, sir.
Okay, that's not a question. It's a request from Ruth, right?
Yes,
We
yes,
Okay.
sir.
appreciate the video can be uploaded tomorrow. I don't know how you normally do it, sir.
No worry. The
Thank you.
responsible person will surely do justice to that. All right?
God bless you, sir.
I mean, and you too. Okay, so in the absence of no further question, this is where we are going to call it a day. Thank you guys for your understanding and patience. So,
And
like I
sir,
said, in our next class, we are going to start from cost of debt. I will explain what is cost of debt, what are the types of debts, all right, okay? How do you determine cost of debt? Then, of course, we have simple or small illustration, just like a short illustration, just like what we've been doing. Then after cost of debt, we are going to talk about cost of convertible securities. So if we still have time, I may introduce you to weighted average cost of capital. Okay, so that's what we are going to do next time by the grace of God. Yes, somebody is talking to me. Somebody wanted to say something. Okay. So thank you guys for your time. I will see you next time by the grace of God. Bye-bye, everyone.
Yes, sir.